I'll be happy to make a presentation about American Finance House's model of financing. And I promise I will take my time to go through, explain the model, explain what we do, why we do it, what we emphasize, what we don't emphasize, and we'll have the Q&A for everybody at the end, if that's okay with you. All right. Our agenda today will be to differentiate the differences between the La Riba model and the Riba bankers. What is the difference in our humble view? As we heard this morning in the presentations, it is not a simple thing that you can put your finger on and say, this is it. It encompasses a number of issues. So we'll go through what differentiates them. Next, we'll talk about the description of the model. What is the faith basis for it? Why do we say this is faith-based? We'll also talk about the application of the model. I'll pick this up so it's not. We'll talk about the application of the model, the benefits that it applies to people outside of the faith, people that are not of the Muslim faith necessarily or any faith. There is still applications and benefits to them. Next will be the payment calculation, how we go about calculating the monthly payment. This seems to be an issue that a lot of our clients are interested in. We'll address what form of documentation we use, and then finally we'll conclude. Next. What is the difference? At La Riba, there's three differences that we always like to stress that differentiates a La Riba banker or a riba-free banker from a traditional banker. The first is La Riba bankers do not rent money. We heard this phrase earlier. We do not rent it, we invest it. What is the difference? Some people say, well, rent money or lend or invest is the same. It really is not. By saying you're investing in it, you're declaring a commitment in what the client is looking to do. It's not simply a loan that I'm going to give you and get it back. Will you be able to pay me back? It is much more than that. It is what is your plans for the money and what do you plan to is that investment acceptable for you and for us or not? The second is when calculating the payment, we never start from an interest rate or any predetermined rate index. We have to start by marking the return to the market. Okay, so what do we mean by marking the market? If we're looking to finance two different things, this microphone and this pointer, for instance, if I were to simply look at the interest of the day and say today's interest is 5%, you want me to help you finance this, it'll be 5%. By the same token, you want me to help you finance the microphone, it'll be 5%. It really is not fair. Why is it not fair? Because the value of this pointer to you is much different than the value of this microphone. You may be able to sell this and earn something far less than 5%. You may be able to rent the microphone and earn quite a bit more than 5%. So the rate of return that I can charge you for financing one of these has to be marked to the market as to what is the value and the benefit of whatever is being financed to you. And we'll apply this concept to homes and other issues as well. The third difference is the social and the taqwa, or the God-fearing side of it. You have to deal with people in a socially responsible manner. Whatever is being financed should be beneficial to the society. If the client encounters trouble in paying, you have to be forgiving. You have to work with them to get them out of trouble. It is not a hammer approach. Either you do this or I come and take your money. It's not predatory lending, as Ms. Smith talked. It is socially promoting type of lending, and we can address that a little bit later as well. Go ahead. What is the model that we use for financing? We heard a few models earlier. We use this model. It's the lease to purchase. In Arabic, it's called ijara waqtina. This is the model. We don't use the murabaha or other forms that are out there. It's the lease to purchase model of financing. And the next slide, will explain that. Before I explain the model, let me tell you why the faith basis for this. The first thing is, as we said, money can be earned from investment and not from lending. Let's take lending. Lending, we've discovered this morning, is a charitable event. When you give a loan as a charitable event, really you're not looking for the money to come back. If it comes back, great. But in jurisprudence of Islam, you're actually giving a loan to God. So that money is being multiplied for you much more than getting it back. So lending is a charitable event. Let's put that aside. What you're doing is investing, and that's why we say we invest, we don't rent the money. When you're investing, that's a business transaction. So as a business transaction, there has to be two sides of the business partners. There has to be cooperation and agreement by both sides. There cannot be coercion. The activity that is being done has to be one that is suitable for both. Suitable both in terms of return, suitable in terms of risk, suitable in terms of time. Your investment horizon and my investment horizon may be different. So in order for us to make a partnership, if you will, or a joint venture to invest, we need to have all these issues in commonality. So that's the faith basis. It is an investment concept rather than a lending. Lending is a charitable event. The returns for calculating that, as we said, we mark to the market. We alluded to the value of this is different than the value of that. It is not a matter of interest rate. Some people will say, well, if you charge me 3%, well, that's not riba. That's not usury. That is not abusive. But on the other hand, if you charge me 10%, well, that's quite abusive. I'd like you to think back on that. If the value of this that you want to finance can only generate 1%, 1% profit to you if you sold it, and I charge you 3%, is that abusive or not? You would say it's abusive. This is not fair. How can you start from 3%? Even though 3% is, say, the prime rate, this is my investor's rate, this is whatever rate, if I come to you with 3% or even 2%, it's abusive. So it is not a question of number as opposed to a question of concept. What is the value to you, and what do I charge you? Again, 10% may be quite reasonable if you can rent this microphone and earn 15 or 20%. So it is a matter of the value, marking to the market. Returns should be marked to the market. Again, that is part of the faith basis of the model. Next. How do we apply the model? This is how the model worked. American Finance House Lariba, AFHL, and the client will purchase the property jointly. And this is a conceptual or an assumption, okay? And I'll address why in a moment. But we purchase the property together with you. Item number 2, we will rent you the share that we financed. If you put 20% of the purchase price, we put in 80% of the purchase price. That means our share is 80, your share is 20. You wish to live in the home, then you're renting my 80% share. If you don't wish to live in the home, if we're going to both rent it to somebody else as an investment, whatever return is generated, you will keep your share, which is 20%, and I will keep my share of 80%. So this is the first part of the model. We purchase it together, and we distribute the return that comes out between you and I. Who pays the return? Whoever is going to live in the property. The third item is American Finance House agrees to sell you their share because you don't want to keep renting forever. The whole reason you came to American Finance House is that you wish to eventually own a home. So you have two choices. Either you stay in an apartment for 30 years until you put together the $300,000 that you need to purchase the home, or you come to us and we do this structure, and in our model we agree to sell you our share for the same amount that we paid for it. If we paid $100,000, you will pay us back $100,000. Nothing in addition to that. While you are taking the time to pay the $100,000, what do you pay in addition to that? You're paying rent. You're paying rent on our share of it. Okay? Next slide, please. What are the benefits to the model? And again, some of these benefits, now we propose that this model applies to everybody, not just people of faith. This has common sense and application to all people. Number one is the monthly payment that you're making is based on marking to the market. So you know that your monthly payment that at least we agree upon is based on the value that you're able to rent this home for. And number two is the real attractiveness of this is to determine the attractiveness of the investment. What do we mean by determining the attractiveness of the investment? If you are facing three different individuals that come to you and say, I would like you to invest in my business. I say, okay, what do you have? Well, I propose to sell pointers that will generate 1% return. Another brother says, I propose to sell microphones that will generate 10%. And another brother that says, I propose to sell something very risky that will generate 100%. I, as the investor partner, I look at all these and I say, well, what meets my criteria, number one, and what are my choices? 1%, I'll be hard-pressed to invest in something that generates 1% when I have another option that generates 5%, or I have another option that generates 10% within the same acceptable framework of investment return. So this is the benefit of this for somebody who does not buy the faith basis of it. We tell them this is a screen. By looking at how much rent can be generated from the property that you're looking to buy, we calculate the rate of return that results from that rent, and then we compare that to the expected rate. What is the expected rate? Let's say what Freddie Mac or Fannie Mae would expect for that term of an investment, for a 30-year financing or a 15-year financing or whatever it is. And then you look at it and you see, is it acceptable or not? If it generates 2 or 3%, there is no reason to invest in it. You're actually better off to rent this property than to buy it. Okay? And we'll have more questions and answers later. Next, please. Okay, how do we calculate our monthly payment? Another very popular question that comes up. The monthly payment consists of two components. As we said, according to the model, we purchase it together. We rent you our share, and we agree to sell you the share that we paid for. So what kind of monthly payment would you expect to pay? That has two parts. The first part is you agree to repurchase our share, the share that you want to own. So you want to end up owning the home after the period of time. So one part of your monthly payment will go towards repurchasing our share. How much that amount is, and we call that repayment of capital, or ROFC, okay? How much that amount is obviously will vary by how fast you want to purchase my share. If you're looking to purchase my share in 5 years, you're going to have to pay a much larger amount each month than if you want to take 30 years to pay. The amount depends on how fast you want to take to pay it back. The second part of the payment is to compensate me for you living in the house. Or if you weren't living in the house, if a third person was living in the house, is to compensate me as an investor for whoever is living there. Somebody is living there that doesn't own that share, so they need to pay the rental equivalent of it. And that's my return. We call that return on capital, because that's the capital that's invested in the transaction. Again, we never start from an interest rate or a predetermined rate. Next. We sort of talked about that. The repayment of capital, this is equivalent to a principal in a traditional financing program, if you will, that a bank would provide. The minimum amount, each month you have to pay a minimum amount that will allow you to complete the purchase by the agreed upon term. And we can go up to 30 years for homes. So if you need to make more, if you like to make more, absolutely acceptable, no problem, no prepayment penalties. You can purchase the whole amount in 1 month, but there's a minimum that we agreed upon as part of the transaction investment terms that we entered into, and that's what we need to adhere to. So it's the minimum The repayment of capital is the minimum amount that you need to pay each month to repay my share. Next. The return on capital, the determination of the rent. Now we're looking into the nitty-gritty of it. How do we agree on the rent? And a lot of people say, well, there's easier ways to do it. But this is how we do it, and I'll explain why it's important to do it this way. The first thing is to determine what the market value of the rent is. And in order to determine what the market value of the rent is, we request the client to get 3 estimates. Why 3 estimates? We heard this morning some people said, well, clients don't have time. They say, well, maybe 1 is enough. Can't we hire somebody to do the estimate? The reason we request 3 estimates is it is virtually impossible to find a home exactly like the one you're looking to buy available for rent. If you did, it'd be perfect. But oftentimes, it's not the case. So how do you determine a value? You have to extrapolate a value by looking at a range of values around it. 2 points, you can, if you remember your math, you can always draw a straight line by 2 points. But 3 points really determine is it a straight line or not. So that's the whole spirit behind the 3. It is not intended to be a burden for anybody. It is intended to educate the client, my partner in this investment, as well as me, as to what is the value of this property that we're looking to buy in terms of a rental cash flow potential. The second is to determine which part of the rent that we both agreed upon, let's say it was $1,000, how much of that will be allocated to me, how much will be allocated to my partner, which is the person looking to finance. And as we said, that allocation is based on the equity of each person or the share that each person contributed to the transaction. So somebody who puts in 20% will get 20% of the rent. Somebody who puts 80% will get 80%. The third is the concept, as you repurchase my share, the portion that I keep getting in rent, let's say I started out at 80%, each month you're making a payment to buy back my share. So my share will decline. You won't continue to pay 80% of the rent each month to me. It'll start out at 80 and it will decline each month. And I'll show you a schedule in the next few slides that will show you exactly how it declines. But the concept is it declines proportionately to my share. Again, it's intended to be socially responsible. You never pay for anything that is more than you need to. You pay only for my share. Next, please. Determination of investment acceptability. How do we know? Let's say we agreed on the rent of $1,000 a month. We agreed that the $1,000 a month generates 7% return. Okay? And any financial calculator can take a look at the cash flows and determine the rate of return that comes out of that. For me to determine is it acceptable or not, like I said, we look at the opportunity of investments available for me. So for home financings, as American Finance House, practically what I do, my investors for long-term home financings are Fannie Mae and Freddie Mac Corporation. I'll explain how they invest with us. But these are my investors for this product, primarily. If the rate of return is, say, 7%, and Freddie Mac and Fannie Mae invest and work with banks and all over the market, if they can get 6% from a Bank of America, and I'm willing to offer them 7%, would that be acceptable, do you think? Would they agree with that? Of course, that's an acceptable return, and they say, yeah, this is a wonderful investment. Again, if the profile of this investment, in terms of term, in terms of credit score, in terms of the appraisal value, all these things are acceptable, and they can get 6 here or 7 here, sure, they'll take the 7 any time. So what we do is when we calculate the rate of return, if it is significantly higher, and the reason I say significantly higher is that if 7% compared to 6%, that's a lot higher. We can definitely do the contract at 7%, and Fannie Mae would be more than happy to take 7%. But in order to be competitive with the market, I go back to you and I say, you know what, my partner, I am willing to accept less than the return that this house generates because my investor is willing to accept less. So I'm willing to reduce the 1,000, make it $950 or $925, so that the rate of return that comes out of this transaction that you're actually paying is a number one, comparable and still meets the expectations of my investors. The second is the mirror opposite of that. If the rate of return that comes out of that investment generates 1 or 2%, I tell you, I'm sorry, I can't finance you. According to the model, you really should not be financing that. You should be renting this home. So I cannot do that. I don't automatically increase the rent from $1,000 to $1,200 or $1,300 and say, hey, this is the rent that you have to pay. I advise you not to buy that. This is not an investment that you should make. And we are the only company where you could have top credit, qualified from an income standpoint, excellent job, an appraisal, a home that's actually appraised higher than the purchase price, and we can still say, I'm sorry, it's not a good investment. We don't advise you to do that. The benefit of this is it really shields the investor from bubbles, from inflationary increases in properties. Because if all properties were viewed in terms of their cash flow potential, it would limit the appreciation that we're seeing all around us right now. The third item and thing that we do is that, let's say the rate of return comes out to about 5.5% or 5.75%, and today our investors are expecting 6%. Technically, this does not qualify. It's not a good investment. But because it's so close, I can advise you. I can tell you, you know, you're probably looking at a home that you can negotiate the price to make it work. Maybe instead of $300,000 purchase price, if you were to negotiate $290,000 or $295,000, that would make it be an acceptable investment in our model, and we would be able to do it. And we've actually been able to achieve that goal of advising some people. Of course, in some markets, when you have 10 bidders standing behind you, it may not be feasible for you to do, but that's precisely the time to get out. You don't want the frenzy mentality. Again, our investors are Freddie Mac and Fannie Mae, and we have other investors as well, but for the homes, and particularly the long-term financing, 15 years, 20 years, 30 years, these are the entities that are willing to do. And they invest with us, by the way. They do not give us loans. They invest. We structure the transaction exactly as I have explained. Then we show it to them to see if it meets their criteria, if it meets their guidelines. And if they agree, they invest in it. Next slide, please. I think I have some more on that. Here's another popular question that comes up. What is the role of Freddie Mac and Fannie Mae? Number one, are they a bank? Do you go to them and say, can I borrow some money? And the answer is no, they are not a bank. Then what is their role? What do they do? Well, Freddie Mac and Fannie Mae, both are public companies, and we had presentations this morning from Fannie Mae. They have two roles that they can play. And either they can play those two roles with only one of the two roles or both roles with a company. For instance, Freddie Mac, for us, acts as an investor. Fannie Mae acts as both an investor and a guarantor. Let's take a look at them. As an investor, what they do is, after we structure the transaction and we calculate the payments and the rate of return, we show it to them. They look at it. They say, yes, we agree. Go ahead, make the financing, and they reimburse us. We put out $100,000 for the financing. They send us $100,000 for the financing, and we earmark this transaction as the investment of Freddie Mac. Payments that come in the future will be earmarked for Freddie Mac. So this is their investor role. Both Freddie Mac and Fannie Mae act as investors with American Finance House Lariba. Fannie Mae also acts as guarantor. Instead of giving us cash, they also, because of their clout, because of their credit rating, their name in the industry, they say, if you wish to pool the mortgage financings that you do, and create a public security, like a bond, a mortgage-backed security, that you can sell to investors, we are happy to guarantee it for you. Why do we guarantee it? Because it meets our criteria and because you'll pay them a fee for it. So they make money by guaranteeing, by getting a fee. So we have been lucky with Fannie Mae. We were the first company in the history of the U.S. and the West to issue mortgage-backed securities backed by these LARIBA structured mortgages. And Fannie Mae guarantees them. And again, they work exactly like any other transaction that we do, and they have the appearance to the investors of a regular MBS that Fannie Mae guarantees. Next slide. Okay, here's one of the sample amortization schedules if you wanted to finance this home. Here's the assumptions. The purchase price is $150,000, and I realize in Pasadena, at least, that may not be realistic. Let's say we're looking to put 20% down payment. The term of the financing is going to be 15 years. And then through our mutual checkings and negotiations, we've agreed that the rental value for this house is $1,000. Okay? We have a computer program. This is the months from 1 to 80. That's 15 years. RONC, if you remember, is the return on capital. It is the share of the rent that you, as my partner, will pay me for you to live in the house. So you're paying my share of the $1,000. So if you start with 20% equity, my share is 80%. So the very first month, you will pay me 80% of the $1,000 or $800. That's my share of the rent in the very first month. In addition to that, you want to pay something to be able to buy my share over 15 years. How much this amount is, we actually have a computer program, a patented computer program, that allows you to pay a level payment each month, and within this level payment, you pay my share, and you pay an amount that's required to complete the purchase by the 15 years. So it's an amortization schedule that basically solves for what level payment should you make each month to be able to pay my share of the return and complete the purchase within the 15-year time frame. So in this case, if purchase price was $150, you put 20% down, that's $30,000. The share that's financed by me is $120,000. So you'll start out at $120. After 1 month, it'll be $119,653 because you purchased $347 worth of shares, or 347 shares of mine. And again, the next month you purchase a little more. My share has declined from 120 to 119, so the rental portion that goes to me is 798. It goes down month by month by month. As your share increases and my share decreases, the rent that goes to me also decreases. Next. What documentation do we use? A lot of companies that operate in the Islamic finance arena have tried very hard and have spent countless monies trying to invent documentation that appear to be Islamic, to be honest with you. We've taken another approach. We say that the laws of the United States are very well stated and very well in favor of the consumer. So we take the standard industry accepted mortgage financing documents that do have references to the term interest in them. But anytime there's a reference to the term interest, it refers to the implied rate of return that comes out of the rental value that we've both agreed upon. So the traditional documents that you see when you come to sign are going to be the same as you see from Bank of America. There's not any difference in those, with the exception of we use a LARIBA financing agreement to supplement those documents. It is not two separate agreements. It is not an agreement that supersedes the legal documents. It is an agreement that supplements it. And what the Lariba Agreement says is that, number one, it defines the investment approach that we took to approach this transaction. And it talks about the rental value that we both agreed upon that's used for the purpose of this financing. And says that for the purpose of complying with the laws, disclosure laws and such, that Ms. Smith would be happy to look for, we make sure that they're all stated in accordance with the law. And it also allows two benefits. It allows you, Mr. Client, to take an interest deduction, should you choose, for the amount of the rental portion of the payment that you're making. And number two, from our side, quite frankly, it helps us because the traditional documents, should there be a dispute between you and us, we're not looking for interpretation of the documents. The traditional documents are there. The laws and the courts are very clear about the roles of the financier versus the homeowner, and there's certain steps that have to be followed in order to proceed. Next. So in conclusion, our model, faith-based, socially responsible. It is not abusive. It is not designed to take care of, take advantage of anybody. It's designed to promote social harmony, and the rate of return is based on the market value rental. But if we can do better than that, we do better than that. Like I said, if the rental value generates a rate of return that is higher than the investor's expectations, we're happy to pass that on to you. We don't have to, but we're happy to pass the savings on to you. And it also assesses and advises or screens for the attractiveness of the investment. Not every investment should be made. Only investments that make economic sense should be made. And lastly, it is very cost competitive and comparable to the traditional financing.